Hi, my name is Inge Patsch and welcome to the series Monetary System Understood. Today, the creation of money and interest rates. As I have already explained in another video how money is created, I will not go into depth in this here, but just very briefly, when you go to the bank and you try to ask for a loan, then basically in this moment money is generated. So this means that it's not the loan which as like you would borrow money from somewhere, but it is that in this moment you pick up the credit, money would be generated by the private bank and you would have your money, but in the same time you would have a debt. So every money existing is debt. For further details on this, please watch my other video. So what we end up having here, and again the reference to my academic source on this, Professor Richard Werner, who has proven that banks actually creating money out of nothing. We have a situation where all the money in existence, besides let's say M0, which is the cash money, but this is a neglectable small amount, so 90 to 95%. Whenever I say in this video all the money existence, I mean all the money created on our deposit accounts in digital form. I'm not referring to currency created by the central bank. So money created in existing is equal to the debt which we have, but the point is that in addition to the actual debt of the principal, there is also a debt on the interest rate. So you see that by this very principle, even in a very simplified system, you will always have more money to be paid back than there is actually money existing. So assume you're the first one to ever borrow a credit and you go to the bank and you ask for 100 euro and you have 10% of interest rate on it, so they would ask you back 110 euro after 1 year, even though only 100 euro have been created in the first hand. So I guess you can already see where does this basic problem lead. But let me highlight another problem, and then I will also help you a bit to understand this with a small story. So let's assume you would have this 100 euro, you took out the loan, you made it work, you did some business or whatsoever, and after 1 year you would go to the money and pay back this money. You would again still be the first and the only person to ever have taken a credit. So this means like this is what is before, and then you would go to the bank and you would pay back the money. And in the moment you pay back money, money is actually again disappearing. So when I talk about money creation and money disappearing, I mean that there is an economic system, and in this money is circulating between banks and individuals and companies and so on. So this is going back and forth. But then there has to be the time where the first time like the tap is open and money is inserted into the system, and the time where this money is withdrawn again. For cash, it's quite simple. The bank is printing it, is giving it out through normally the public, through normally private banks, and then is bringing it back in again. So it's just saying and it's destroying it again. But for all the digital money existing, again, this is between 80 and 95% of the money. In the moment a loan is given out, it's created. In the moment the loan is given back, money would disappear. But what would it mean if all of a sudden money would disappear from the system? We would have a huge deflation, and none of the economy would work anymore if all of a sudden we had no money. But let me tell you a small story about this, which makes it even more graspable. Imagine an island, and on this island 100 people living. So each 10 people have a big family, business running. Some are carpenters, some are farmers. One is a hairdresser, and so on. One is a tailor. So they have their nice subsistence economy, and everyone is just providing things to another. And one day now a banker strands on this island, and he has nothing in his pocket but one purse with 100 gold coins. And he's reaching out to the people from the island and saying, what are you doing? You have like all your 10 family businesses. Why are you handling this without money? That's not efficient. You know what? I give a loan to each of you. So he's providing a loan. He's giving away all of his coins. So he would give every family business, he would give them 10 euro and saying, well, you have 1 year time, and after 1 year you have to give me back 11 euro. We call that interest. So what will happen if, for whichever reason the citizens agree upon, so these island people agree upon, and they would start working with money. But then apparently after 1 year, well, there are not 110 gold coins on this island because the island itself doesn't have a gold. But after 1 year, the banker is actually asking back 11 gold coins of everyone, but it's not there. So the first effect we might see, I assume, is that people would try to not be the one who is the one not paying back. So they would try to be the one who just grabs the last coin from someone else, no? So after 1 year, there is a big community gathering, and the banker is saying, so where is my money? And people are saying, a few people managed, so they gave him back the 11 coins. But then a few other people figured out, okay, they didn't have it, so he's saying, well, you can get another loan. And in addition, the banker knows, well, if I take back the money now, there is no money in circulation anymore. So he will convince them in picking up more loans, no? Because otherwise all the money would be back, and people would be back like, what would they use for trading, no? So he is giving them another loan and saying, well, but you still owe me like the percentage of this year, but next year you have to also take a loan for this. So in the next year they owe him already 11 gold coins. And that way it would go on and on. So you understand now, maybe it's the same system we have globally, just with many more players, and not that everyone at the same time has to pay back his credit, but that this is like time, there is a delay in time, there are different time frames and so on. But the principle stays the same. If all the money would be paid back, there is nothing anymore left over to circulate. And every year people have to pick up a loan in order to either be able to pay off their interest rate, or in order to cover up for what they were not having because someone else had it in the moment they had to pay back their loan to the banker. And therefore they only had 8 silver coins in the end of the year, because 2 of their silver coins were maybe with someone else who could pay back. So you understand how there is a systemic problem, and it's impossible to have a win-win-win situation for everyone in a system which is creating money out of debt and is in addition to have this heavy disinterest rate. So this idea of saying, okay, there is the money, so you will always have an extra amount of money you will create, but then for this extra amount of money, there is again an interest rate. So you see how this pile of debt is always increasing more than the pile of money. In addition to this dynamic, well, this is nothing I'm basing on in research, but this is my interpretation of things. In addition to this development we have now, that there is this whole area of financial speculation bubble, which is actually having a tremendous amount of money. Tremendous. Again, check out visualcapitalist.com and you will get like all dizzy if you see these numbers. Where actually the money here, this is the money which is in interaction with the gross domestic product. So this is the money which works, and I have explained this in another video, so which works actually in order to keep the real economy alive, so that suppliers can pay money to their employees and the employees can pay money in the supermarket and so on. So this is what really keeps the money alive. But then there is a huge amount of money actually in the speculation bubble. And I assume, again, this is my assumption, this is a working hypothesis, this is nothing I can really show you on a piece of paper, that from this money created out of debt, much of the money is actually siphoned, is flowing very fast. It goes maybe once or twice in the economic circle here, but then it ends up in the speculation bubble. So we have to create even more and more money over here just in order to make sure we have enough money in order to keep the real economy running, while over here is some kind of crazy financial concert going on in speculation. So not all speculation per se is bad, but there is much speculation going on in this realm. And meanwhile, this pile of debt is piling up and piling up. So I hope I could show you how actually money is, or interest rate particular, is reason why there has to be an ever-occurring growth, and this growth will reach exponential dimensions, and without, as long as we have interest rate, there is no way how to get out of this spiral of increasing and ever-increasing debt. I hope you have enjoyed this video so far. Please go check out also my other videos on the monetary system explained, and thanks for watching.